A stock that is up over 3,000% in a single year, and analysts are still telling you to buy it. That either means you just missed the greatest trade of your life, or there is something very dangerous happening that most retail investors are completely ignoring right now. Today we are breaking down SanDisk, ticker SNDK, a company that spun off from Western Digital not long ago and has already exploded into a market cap north of $200 billion. We are going to look at the numbers, the bull case, the bear case, and what smart money is actually doing with this stock right now. So stay with me because this one gets interesting fast. Let's start with the move itself, because it is honestly hard to believe. The stock has gained over 192% in the last 52 weeks. The 50-day moving average is sitting around $906, while the 200-day moving average is all the way back at $415, which tells you this rally has been absolutely relentless. The RSI is at 64, so it is elevated, but not technically in screaming overbought territory yet. But here's the real question. Nobody is asking, what is actually driving this? Is it fundamentals or just pure FOMO? Now let's talk fundamentals, because this is where it gets genuinely impressive. SanDisk is pulling in $13.18 billion in revenue with a gross margin of 56%. That is software company territory for what is essentially a hardware business. Net income hit $4.51 billion. That's a profit margin of over 34%. Free cash flow came in at a fat $4.46 billion. And the balance sheet is almost comically clean. Only $207 million in debt against $74 billion in cash. Return on equity is sitting at 39%. And return on invested capital is nearly 49%. These are elite tier numbers. The company has 11,000 employees generating $1.2 million in revenue per person. That is exceptional operational efficiency. Here is the bull case. The forward PE on this stock is 8.72. That means if earnings grow anywhere close to what analysts project over the next 12 months, this stock is actually cheap right now at current prices. The PEG ratio of 0.03 is basically screaming undervaluation on a growth-adjusted basis. Revenue is forecast to grow at 25% annually for the next 5 years. The balance sheet is fortress-level clean, with almost no debt. SanDisk controls a massive portion of the NAND flash memory market, and as AI infrastructure, data centers, and consumer devices all demand more storage, this company sits right in the middle of all of it. And here's something that might surprise you. Despite the insane stock run, institutional investors own nearly 78% of shares. They are not running from this stock. They are holding now for the risks because no good analysis skips this part. The trailing PE of 46 is not cheap by any standard, and more importantly, the analyst consensus price target is $953. The stock right now is trading well above that. That is a 31% gap between where smart money thinks this stock should be and where it actually is. That is a serious warning sign. The memory chip business is also notoriously cyclical. When demand drops, and it always does eventually, margins get crushed fast. Short interest has been climbing month over month, sitting at over 7% of the float. So ask yourself, who is on the other side of this trade? Because sophisticated short sellers do not pile in without a reason. The stock also has no dividend and is actually diluting shareholders slightly, with shares up 4.66% year over year. The Altman Z-score of 8.34 puts SanDisk deep in the safe zone financially. Bankruptcy risk is essentially zero. The Piotrowski F-score of 6 out of 9 is solid but not perfect, meaning there are a couple of weaker signals in the fundamentals. The interest coverage ratio of nearly 49 times means debt is basically a non-issue. Institutions own 77.68% of the float. That is a vote of confidence from the smartest money in the room. So here is where I land on SanDisk. The fundamentals are genuinely elite. Cash machine, clean balance sheet, growing market, dominant position in memory. The forward valuation tells a story of a stock that has a lot more earnings power ahead of it than the headline price suggests. But the 3,000% run, the stock price sitting 31% above analyst targets, and rising short interest all demand respect. You do not chase a stock up 3,000% without a plan. If you already own it, the fundamentals say you do not panic out. If you're thinking about buying now, wait for a real pullback and do not bet money you cannot afford to lose. This is not a screaming buy at any price, but the business itself is one of the most impressive setups in the storage space right now. If this breakdown gave you an edge, hit subscribe because we do this every week. Real numbers, real analysis, no fluff. Drop a comment below.